that's me. So I'm Paul Angell, I'm the Head of Investment Research at AJ Bell. And I wanted to start my presentation by asking a couple of questions. We haven't had any audience engagement yet, so the first one is this. Who in the room, it's going to be a simple hands up situation. Who in the room worries about what to invest in, be it a stock or a fund? Who's worried at that point of allocating your money to a stock or a fund? So I'd say at least 50% of the room. Okay, so you've invested into a stock or a fund. Is that the end of the worry? Or are you then worried that you need to get out of that stock or fund? Hands up if you're continually worried, but a slightly different worry about getting out of the market or out of the stock or the fund. Because maybe you haven't followed some company news, or maybe you're not aware of what's happening with the fund. Maybe there's been a fund manager departure or a change of philosophy or process. So who continues to worry even once they're invested? Okay. Firstly, commendation, or I commend you for your honesty, because I know the feeling as well. And hopefully, what my presentation today will show is that we're here to offer a solution to park some of that worry, maybe park all of that worry, and I would say that. But we do have investment funds that are invested for the long term, where hopefully you don't need to worry so much in the short term and let someone else do the hard work of investing. Okay, so I think most people in the room should be pretty familiar with AJ Bell as a business, given you've been invited to attend tonight. I'm not sure what the invitation requirements were, presumably that you're platform clients. So you should be aware that we are one of the largest investment platforms in the UK. We've now got 86 billion sterling of assets under advice, or asset under management, advice, better word, advice, as a business, over 500,000 individual customers, and we're now one of sort of a medium-sized company within British PLC landscape with over 1,000 employees. Maybe you're less familiar with AJ Bell's investments proposition. So the AJ Bell investments team sit within the AJ Bell business. That's the part of the business I work for, is AJ Bell Investments. We started in 2016. We've had a great rate of growth since then, which you can see in the chart on the right-hand side. We've had a lot of success in what we've done, I'd be pleased to say, and we've won a number of awards that we've listed some of them there from the industry to commend us in the work that we've been doing within what I'm about to share with you now. Oh dear. Hopefully you got your glasses on for the middle ones. So my colleague always says, what are we trying to do? We're trying to make our investors look like this guy with his feet up and enjoying the view, which is probably a fair point, probably why it's in the slide. But we've got three central kind of pillars to our investment philosophy, or what we're trying to deliver to you as investors. We're always trying to be simple, we're always trying to be low cost, and we're always trying to be transparent. This slide does not make it look like we're trying to be transparent. But for some reason, there's been some sort of text shrinkage since I put it in. Anyway, so what? Lovely idea, simple, low cost, transparent. I was talking to someone earlier. They were saying, it's also complex, this financial world. So we're trying to break down some of that complexity. And how are we trying to do that? Well, simple. As soon as you put the money, as soon as you invest in one of our funds, you get allocation to a multi-asset approach. We buy lots of different stocks, both company shares and fixed income securities of governments and corporates, and they're all across the world. But we only buy straightforward assets. We only buy cash, stocks, i.e. company shares, and fixed incomes. We don't involve in any of the more complex areas of the market. Low cost. So let's get the magnifying glass out here. So we're invested solely in low cost passive funds. So we're a multi-asset fund investing in other funds. We can invest in any fund in the market. We're not sort of tied to any particular investment group. And what we're able to do then is always try and get the most effective and lowest cost underlying fund. And what that means is that across our 6 growth funds that I'll introduce you to in a moment, we have a capped OCF at 31 basis points. What's 31 basis points? That's 0.31%. What's 0.31%? Well, if you put £1,000 in one of the funds, it'll cost you £3.10 a year to have that investment, which we think is really good value. Some of that goes off to the underlying managers. Some of that pays the fees that we need to manage the funds as well. So we are low cost. And then finally, despite the slide not showing so, we are transparent. You can go on the website at any point, look at the latest communications, be that video, text, quarterly fact sheets, that kind of thing. So that's what we're about: simple, low cost, and transparent. We're also about choice. We've got kind of a solution for any need. We've got 6 growth funds. They go all the way from cautious up to global growth. So we'll look at the kind of risk spectrum a bit later on in the presentation. We've got 2 income funds, one kind of standard income fund, and then what we call an income and growth fund. So it's a fund that's trying to deliver a decent yield while also growing capital over time. And then finally, we've got a responsible growth fund as well. And what we do here is, again, we invest in passive funds. So we're not using active managers within these solutions, but the passive funds themselves have got negative screens on them, so they don't invest in things like oil and gas, tobacco, or alcohol, but also they've got some positive screens as well, so they're tilted towards companies that score better on environmental, social, and governance factors. So 9 funds across the piece there. So what do we do? So we've got these funds. We're simple, we're low cost, transparent, but what do we do? It's come up a number of times this evening, which has been great, but we are long-term investors, and that's probably the most important place to start. We don't listen to the market noise. See the chap in the bottom corner. We're not forever trying to trade here, there, and everywhere, but we're looking at long-term expected returns within markets. We are correlating the markets in terms of what those long-term returns will be, and what the volatility of those returns will be, and we're using those outputs to build our portfolios. Here we show the balanced fund, 60% equities broadly, 40% cash and bonds, quite a conventional approach to managing a balanced portfolio there. We're diversified, so I've touched on this already, but we use broad asset classes. So again, this is our balanced fund. You've got a large equity component in kind of the red bar, and then you've got a large cash and bonds component in the black bar. But not only have we got the kind of equities and bonds and cash, you go a level down. We've got UK equities, and we've got non-UK equities, and then in the cash side, we've got sterling cash and bonds, and then we've got global cash and bonds. And the important thing here is you get some currency diversification benefits of having UK and non-UK assets. So that's all in there. You go there's another cliff edge there. That's good. You go another level into the wagon wheel, and you get all the different industries. So we have some tech. We have the income sectors that were spoken about earlier as well. It's all bundled up within the proposition. Thousands and thousands of companies sitting underneath this one managed proposition at the headline level. So risk. So as I said, there are 6 different. This is just our capital growth portfolios. There are 6 different risk categories that we manage to, from cautious, take a bit more risk, get to moderately cautious. So on the x-axis here, you see the amount of risk that is needed to take, or is both targeted and then effectively taken within the funds. And then on the y-axis, you have the targeted return, and as we'll see in a moment, realised return, broadly speaking, as well within these funds. But anyway, the idea is that once you assess your risk parameters or your risk tolerance, then you can choose the appropriate fund for yourself. How much volatility are you willing to accept for a expected level of return? And then how do we work out which asset classes to put into which of these funds in what quantity? Well, we use expected returns of all the various underlying asset classes. As I said earlier, we look at the correlation of the asset classes with one another, their expected volatility as well, and that we put all of that into a model which tells us what allocation we should be using within some of our portfolio constraints that we have. And then on top of that, we can make tactical adjustments. So when we think that the model is not appropriately understanding a risk within an asset class, so take high yield bonds at the moment, so lower quality bonds, they've performed fantastically for a number of years now. They've been the best part of fixed income to be in. But all that's meant is that the spread on the bonds has got smaller and smaller and smaller. So if you just looked at the performance, you think, what a fantastic fund this is, I need to get invested. But actually the risk within the fund is getting bigger and bigger and bigger because the actual credit default payment that you're getting within the underlying bonds is reducing with every year of good performance. So we have that kind of ability to look tactically at what the model tells us to do, and in that instance we've reduced the amount of high yield exposure that we have. Another thing that we're looking at doing is within US equities, so the model says, oh, own this amount of US equities, and we're saying, well, hang on a minute, US equities, that's become a very concentrated market with a lot of companies that have done extremely well, becoming a large part of that market. And one thing we're able to do at the tactical level is say, well, hang on a minute, how about we equal weight the index? So we don't take those huge positions or relatively large positions in the likes of NVIDIA or Apple or Microsoft, but rather we have a more balanced approach across industries in the US. So does it work? We actually did submit this slide, so no defences here, because again, it's difficult to see, but the dots kind of to your left-hand side, these are our funds, and they correspond to the sectors on the right-hand side. On the axes, we've got the annualized volatility and the annualized return on the y-axis. And what you'll see is that on each of the categories, on a 5-year annualized basis, our funds are nicely up and to the left. So they're delivering more return for a lower level of risk versus the peer group. And the peer group is the industry's combination of funds looking to achieve a similar risk and return profile to our funds here. So we're really pleased with this track record, and it's a big part of the reason why we've won a lot of awards and why we've been growing assets so nicely in recent years. So, summary. Going all the way back to those questions at the beginning, hopefully I've showed that there are ways to reduce the amount of concern perhaps that you have when you're putting investments into the market. Now, the fact that you're here tonight probably means that to some extent you're enthusiasts, you enjoy investing in the market. I was speaking to someone earlier today who clearly had a great passion for investing in the markets. That's great, but maybe you want to park a certain component of your assets, of your cash, into a fund like this, where you don't have to be as concerned day to day. It's diversified, it's low cost, you can always see what's going on within it, and there's that focus on risk and asset allocation and diversification, as I said. I finished within time with a minute to spare, so I think you'll all thank me for that, because otherwise we're quite over time. So thank you very much.